Great one, just spreading a little bit of knowledge. Check this out, fam. When a company decides to go public through an initial public offering, it's called an IPO. The pricing of its stock involves several steps. Step number 1, valuation. The company's financials are analyzed to determine its value. This involves looking at revenue, profits, and growth potential, industry comparisons, and other factors. All right, number 2, check this out. It's called a roadshow. The company, along with its underwriters, i.e. banks, investment banks, conducts a roadshow to pitch the IPO to potential investors. This helps gauge investors' interest in the sentiment. Now check this out. Number 3, book building. During the roadshow, investors indicate how many shares they are willing to buy and at what price. You follow what I'm saying? For the IPO. This information is used to build an order book, which helps determine demand. All right, price range. Based on investors' feedback. See, it's all based on feedback and emotions and price and demand. The company and its underwriter sets a price range within which they believe the stock should be priced. Final pricing. On the night before the IPO, the company and its underwriters finalize the price at which the shares will be sold to the public. This is based on demand, market conditions, and other factors. So if you learn how to follow these companies within these charts on when they're hot and when they're cold, that's my term in putting it, you're going to make some money. Trading the belt. The next day the stock begins trading on the exchange, the opening price is often higher or lower than an IPO price, depending on the market dynamics and investors' demand. Overall, the pricing of an IPO stocks is a complex process that involves balancing the company's value. Investors demand a market condition. So, on a couple of these platforms, let's say Webull, Fidelity, Robinhood, they got a section where you can know about the next IPO that's coming up. Now, the employees and the company heads, they automatically got shares. It's their company, but they're deciding on whether they're going to, set their IPO stock price at for you to be, a first-time buyer of initial public offering. And those are good to grab. You know what I mean? Because you catching these stocks before they actually, hit the market and start fluctuating with price and demand. It's a good thing to learn. IPOs, look them up. Initial public offering. Peace. Great one. Just getting a little information. 100.